Hello and welcome to Bloomberg Quint. You're watching Insolvency Diaries, a news segment created to discuss the various developments which are taking place in the insolvency and bankruptcy space. With the 270-day deadline drawing closer, the 12 large stressed cases which form the first list shortlisted by the RBI are seeing resolution plans being submitted. While the 5 steel accounts have seen considerable interest from potential buyers, the other companies are still looking for good deals. Steel companies, by their very nature, have large assets under their control, which can fetch a lot of value. Moreover, the improvement in the business cycle for steel has also led to better valuation. Other infrastructure companies, though, such as those in the development project segment, may not be as attractive. This could force lenders to take a deeper haircut for such cases. This week on Insolvency Diaries, we take a look at 2 such cases which are part of the RBI's first list and can be used as proxies to understand the difference between the value between steel and non-steel accounts under the Insolvency and Bankruptcy Code. Hyderabad-based Lanco Infratech has been facing severe financial stress since 2013. Lenders led by IDBI Bank and ICICI Bank had tried to restructure the account under the corporate debt restructuring and strategic debt restructuring schemes with little success. Lanco's promoters had also announced strategic asset sales as a move to reduce the debt that too had failed. After the RBI named it under the 12 stressed accounts list in June 2017, IDBI Bank moved the NCLT to get Lanco Infratech admitted under the Insolvency and Bankruptcy Code. According to the claims admitted by the resolution professional, Lanco's financial creditors are owed over 45,000 crore rupees, while operational creditors' claims worth 5,000 crore rupees have been admitted. Sources close to the resolution process confirmed that 4 bidders had submitted resolution plans for Lanco Infratech, of which only OPG Group's plan was shortlisted by lenders for consideration. Through its plan, OPG Group has offered to buy Lanco Infratech after a 90% haircut on the dues owed to the company's creditors. Currently, lenders are negotiating with OPG Group for a better offer. In comparison, the resolution plan proposed by JSW and Aeon Capital for Moneth Ispat and Energy has sought a 76% haircut for the company. The resolution plan also involves an upfront payment of about 2,365 crore rupees to the lenders and about 1,055 crore rupees being allocated for capital expenditure, working capital and transaction-related expenses. Operational creditors who are owed over 433 crore rupees will receive nothing according to the plan. Bloomberg Quint reported on Tuesday that the Committee of Creditors had accepted the bid submitted by JSW Group and Aeon Capital. To better understand the difference between haircuts being prescribed for steel and non-steel accounts, we have with us Krishnan Sitaraman, Senior Director with CRISIL. Krishnan, let me first throw this question to you. What exactly are the kind of haircuts or, returns that lenders can expect whenever it comes to accounts that are not steel? Considering that these accounts which are into infrastructure development may not have the kind of assets that a steel asset would generally have.
Yeah, so what we had done at CRISIL, we had looked at the top 50 corporate NPAs and done an account-by-account analysis on the kind of recovery or resolution prospects that each of those accounts would entail, and divided the potential haircut levels into 4 buckets, that is 0 to 25, 25 to 50, 50 to 75, and 75 to 100. And while haircuts varied from account to account, on an average, our sense was for the top 50 accounts, the average haircut levels would be in the range of around 60% on an average. Now, as you've rightly mentioned, over the last, say, few months or so, because of the uptick in steel prices, we've seen a higher capacity utilization and a greater interest in the steel segment and the NPAs which are focused on steel. And we believe that the haircut levels are expected to be lower in that segment. So if you look at other non-steel segments, the average, as we talked about, should be in the range of around 60%. Yes, there could be higher haircuts in certain accounts, so that is definitely a possibility. And some of these accounts could entail deep haircuts, but where there are good quality assets, a good business model in place, there is a potential that the haircuts could be lower.
Let's also, look at what the RBI has come up with recently in terms of these stressed asset guidelines, the revamped stressed asset guidelines, which direct bankers to use the Insolvency and Bankruptcy Code as much as possible to resolve some of these assets. Is it fair to expect that a large part of the NPAs, which will now go into IBC, will fetch only about 50–60% of the value of these assets?
Yeah, so the way I was looking at it, so on an average, our assessment of the top 50 accounts is indicating an average haircut level of 60 odd percent. It may have come down a little bit because of the upturn in the steel cycle, but on an average, it shouldn't be too much higher than 55 to 60 odd percent. But again, as I said, it would vary from account to account. Where there is a good business model, adequate cash flows in place, still you could expect less of haircuts. But clearly, it will be difficult to get, say, 90% of your value or a 95% of the value. Those are the scenarios which actually play out in developed economies like US or Japan, where post the streamlining and introduction of this kind of a legislation, we've seen recovery levels in the range of 80 to 90% and a recovery timeline of around 1 year. So we will take some time to get to that level. What we are looking at is a situation better than what we were accustomed to earlier, and that is, I would say, a step in the right direction.
All right. Last question, Krishnan. Let's, looking at, and what I was getting at in the previous question also was that now that the Reserve Bank has mandated this IBC to be the primary source of resolution as companies cross a certain threshold, now that there won't be any delay between the default and the resolution, do you think that then probably we could see higher rates of return closer to what you were saying about international markets?
Yeah, so we are expecting the recent stressed asset resolution framework which RBI has come up with. It is expected to standardize and streamline processes towards resolution and recovery, and it will bring in a greater level of transparency. So it is beneficial over a long-term perspective. And what we do hope is the element of timelines getting extended on and on for and which plays a key role in reducing the haircut or reducing the recovery levels in the resolution process, that will be crunched. And since we are immediately expected to take action post delay happening, and delay has also been defined as a 1-day delay, and if that is the situation and all the lenders are either singly or jointly expected to commence a resolution process immediately on the occurrence of delay, that will definitely help in quickening the process of resolution and hence increase recovery levels going forward.
All right, Krishnan, thank you so much for joining us on Insolvency Diaries. It's been a pleasure talking to you. While discussing the kind of valuations pitched for the insolvency accounts, it is also important to understand what constitutes a resolution plan. Bloomberg Quint's Payaswini Upadhyay spoke to Nitin Jain, the restructuring partner at EY, to understand the various components of a resolution plan and the way stressed assets are being restructured currently.
Nitin, thank you for joining us on Insolvency Diaries today. Let me start by asking you some of the common approaches that people are taking towards the debt that is there on the books of the stressed companies. And while I know that each resolution plan will be unique and specific to the stressed asset that we are dealing with, can you explain to me what are some of the common approaches that resolution applicants are taking to reduce the debt of the stressed companies facing insolvency proceedings?
You see, as you rightly mentioned, Payaswini, it all depends on the specific asset which you are dealing with, because there could be assets which are very well which are very good operationally, and they don't have non-core assets, and there could be assets or the businesses which may have lot of non-core assets or assets which are not cash generating. So depending on the quality of the asset or the business which you are dealing with, a resolution plan can be sort out. So for example, if there is a steel company which is doing operationally very well, so one would like to see how much debt is sustainable based on the operations, and basis that he will try to prepare his resolution plan to see how much return he can make or the investor can make on the equity upside, on the equity side. So, and depending on the investor also, so if it is a financial investor, they always look upon for a return on their equity or the investment which they are going to make, wherein if it is a strategic investor, they also look upon other factors such as strategic interest or the market share or future growth potential or the expansion capability of the asset, etc. And then obviously they will use tools such as non-core assets which are there in that business to deleverage the debt further. So once you have arrived at a sustainable number of debt and the amount of equity which you intend to put in, you can always sort of top it up with the value of non-core assets, which we can monetize in near future to make it a viable plan.
Nitin, like you pointed out, some of these assets may be operationally viable, which is why they are seeing the interest. So there may not be a large-scale restructuring that may be required, but surely refinancing of the debt will be required in these companies to make that debt sustainable or less expensive. Could you take me through some of the refinancing tools that resolution applicants are adopting and proposing to the Committee of Creditors?
Yeah, sure. So, for example, as I mentioned, that restructuring can be of two types. Most of these power assets which we are seeing, which doesn't have a PPA or a coal linkage, or where the merchant tariffs are very low. But on the other hand, we have all these steel assets which are operationally viable businesses per se, means they are generating cash, they have ability to expand, they have the ability to throw in a large amount of cash. The only problem which they are currently facing is the higher amount of debt which is sitting on the balance sheet. And once you fix that, the businesses are viable. So as we have seen in the case of one of the largest steel asset, which is Bhushan Steel, the buyer has come in with an option of refinancing almost 70% of the debt at terms which are viable and which are sustainable. And then they are also offering a significant amount of equity to the lenders. And similarly, in other cases also, you will see that the buyers who are coming in, be it a strategic buyer or a private equity player, where the businesses are operationally viable, they are bringing in new capital to refinance the entire debt, existing debt, and sort of getting the creditors out of the company. And there are cases where the existing creditors themselves are taking a credit call on the new investor or a buyer or a strategic player to refinance the entire debt to come up with a resolution plan.
Okay, talk to me a little bit about the evaluation matrix that the creditor committees are using to pick one plan over the other, strictly from the point of view of how resolution applicants are proposing to rework the debt.
So this is all evolving, Payasmi, as you see. Initially, when NCLT law sort of came into picture, and the initial resolution plan, where obviously there was no criteria for evaluation. The IRPs were evaluating, or the COCs were evaluating based on the sort of NPV or the maximum value which one was offering. But now IBBI has sort of come out with an indicative sort of matrix which provides points on various pointers or various sort of points which are included in the resolution plan. Just in case, there are points for the NPV which the buyer or the investor is offering. There are points how much upfront cash the investor is bringing in. There are points for the operational capability of the buyer or the investor to sort of revive the business. There are points for equity which they are willing to offer. So these are all sort of indicative pointers which have been laid down as per in the evaluation matrix, basis which there are sort of points allotted to each investor or the buyer to arrive at the best value for the COC or for the lenders or the financial creditors.
And this evaluation matrix, does it give potential resolution applicant higher weightage if they bring in upfront infusion of equity?
Yeah, so there is an incremental weightage or points which are given to a resolution applicant if they are bringing in more cash upfront in the form of either debt or equity. So there is definitely higher weightage given to those resolution applicant in the evaluation matrix.
Okay, so that's what's happening with the debt. Give me a flavor of what's the approach towards the equity component in these stressed assets.
You see, equity component, it's a very a different approach basis the investor who's looking at asset. As I pointed out earlier in our conversation, if it is a financial investor, the financial investor always see equity from a return perspective as to how much return he can make by investing an X amount into the company, right? And they will always look at a debt equity structure of 70-30 or a 80-20 or a 60-40 or a 5 times debt and then sort of 2x 2 times equity, so that they can make a return on their investment in near future. Their normal time frame for any financial investor is around 4 to 5 years in these kind of assets. So they want to sort of invest money in the asset and get out 5 to 6 years, over a period of 5 to 6 years. Wherein for a strategic investor, the value of equity is not only the return which he is going to make on the capital which is going to invest, but also on the future potential of the asset which it can sort of offer to him. So for example, there are steel assets, and we have seen in some of the cases where people or the investors are investing for the future potential of that asset, because that can be expanded, sort of or the capacity of that asset can be expanded twice of what it is today. And sort of you are leveraging on the value, on the fact that the infrastructure cost which has already been incurred is already there, and you will have to spend a lesser amount of capital to expand the capacity from X million tons or X sort of millions to 2X million tons. So that is where also you leverage on the equity value, and you create equity value for yourself. And then also it's also about grabbing the market share, as you would see in the case of recent sort of resolution in cement company, where people are bidding for sort of people are willing to increase the sort of value for the asset just to grab the market share. So it's all about depend upon how the person or the investor or the sort of buyer who's looking at the asset. So that's where the equity value lies.
Okay, and what happens to public shareholders or minority shareholders? Is it given that because there is no economic or equity value left in the company, this group of stakeholder will get nothing, or are the resolution applicants keeping the interest of minority shareholders also in mind while proposing these plans?
So it's a very tricky question and very tricky, sort of point to answer. So one, it depends on the type of asset we are talking about. So if the asset doesn't have any, if the value of the asset is lower than the debt value, right? So definitely there is no value for the equity, because equity has the last sort of stake in the waterfall when you see the capital structure, right? So in most of the assets where we are seeing a resolution, or we are discussing resolutions, most of these assets have the value of these assets or businesses are lower than the value of debt which they have today, right? So there's no question of equity value left in the business. But now you need to evaluate from other perspective also, because once you wipe out the entire minority shareholders from the company, there are a couple of questions which need to be answered. One, minority shareholders can always sort of raise concerns about the process itself, and they may enter into a litigation, so you would want to avoid that. Second, if the investor wants to have the listed vehicle itself, right? So taking out minority interest shareholders completely may not be a viable option, because then you will have to go for sort of you will have to go for either a IPO again, or you will have to sort of bring your equity down below 75% as per the stock exchange SEBI rules. So that is where the dilemma of the investor would be, whether they want to sort of keep the listed vehicle or they want to exit completely. There are investors who are willing to sort of take the punt and get the delisting done, but then there is a process to be followed, because NCLT doesn't provide you a single window clearance of delisting. You need to go to SEBI, you need to go to exchanges for sort of approvals, etc. So to avoid those delays in the process, because the NCLT process is a time-bound process, you won't want to sort of delay it just because you want to delist. What we are seeing in sort of in most of the resolution plan, there is some amount of equity is being kept for the minority shareholders, but definitely they are being diluted to a significant lower level. So for example, if they are 30% currently in the listed vehicle, they're getting down to 3% or 4% or 5% in the pie. And you would have seen in recent one of the cases which was published yesterday, wherein the sort of public shareholding was 30-35% before the resolution, and they are coming down to 3% by virtue of the new infusion which is being made by the upcoming investor.
And this is because there is a reduction in fair value, or the equity is coming in at a lower value, right?
Yeah, so basically what they are doing is, so obviously both the options are available as per the law now, because you can reduce the capital as such, or you can sort of bring in capital at a lower value or a lower face value to dilute the existing shareholders which are at a higher face value. So we are seeing both the options being utilized by the investors.
Okay, final question then, and it's an important one because like you mentioned in our conversation offline, nobody has a ready answer for it. What is happening with contingent liabilities such as tax claims or ongoing litigation? How are these being accounted for, and what is the approach that you are seeing in the resolution plans that are currently in the works?
So this is a question which every investor or the strategic buyer or sort of person who's coming in with a resolution plan is grappling with. So contingent liabilities can also be sort of segregated into two kinds. One, contingent liability where the outcome in terms of the value, only contingency is whether that liability is certain or not. But there are contingent liabilities where the value is also not certain. So the view which legal people are taking in these cases is that there could be a possibility where the contingent liability, value of the contingent liability is not certain in terms of what would be the final outcome, right? There could be a possibility in future that the creditor who has this liability can come up and take the plea in the court that this liability was not ascertainable at that point in time. How could you resolve that in your resolution plan? So this is something which is evolved. That's our belief, because this is a new law. Nobody has seen what is the view of the courts on these cases, on these matters. So this is something which people are grappling with and sort of unable to take calls. And especially when the liability sort of involves some sort of a statutory payments or some sort of a statutory liability such as taxation, etc., or to do with some sort of a public litigation, the concern becomes more important, because court, in those cases court may take a view that these liabilities need to be taken care of by the investor. So that is where obviously people are grappling with.
Well, I suspect some of these answers will emerge when the 12 big cases or any of the 12 big cases see fruition in terms of a final resolution plan. Nitin, thank you for joining us on the Insolvency Diaries today.
That was Nitin Jain of EY. Do join us next week for more insights on the insolvency and bankruptcy space. Thank you for joining in.